Profitable companies have a few different ways that they can return excess cash to their shareholders. Dividend payments are probably the most common and well known way, but a company can also choose to do a share buyback or share repurchase program. Both of those terms are interchangeable and have the same meaning, but basically, a share buyback happens when a company uses some of its cash to buy shares of its own stock on the open market. Why would a company do this? Let's have a look. Public companies are usually managed with the main goal of maximizing return to its shareholders. Because of this, a company that's generating more cash than it needs to fund its own operations and investments might choose to return that excess cash to its shareholders. As mentioned at the top, dividends are the most common and best known way for a company to do this. They'll make periodic cash payments to the shareholders, but that's not the only way. Sometimes a company's board of directors will decide that the excess cash is best spent on a share buyback. But why pick that option over dividend payments? The excess cash being considered may just be a one off, and because of that, the company may not want to commit to paying a dividend or to increase its existing dividend on an ongoing basis. An ongoing dividend can be a burden to a company during hard times if it needs to be maintained and leaves investors upset if it's cut. Alternatively, the board may feel that the company stock is undervalued and a good price, making it a good investment. Because of this, a buyback is often perceived as an expression of confidence by the company because it's backing itself. Okay, so with a dividend, you could get cold hard cash, but how does a buyback impact you as an investor? It would be easy to view the dividend payment as more desirable since the stock buyback program offers no immediate direct benefit to you when compared to cash in hand. But shareholders do benefit indirectly from a buyback or repurchase program. The goal is usually to raise a company's stock price. The idea is that taking shares out of circulation, the remaining shares will be worth more. It doesn't always work out exactly that way in practice. On one hand, just the announcement of a share repurchase program is sometimes enough to give the stock a boost before the company has bought any shares. On the other hand, sometimes there's unfavorable news or a shift in the market while the company is in the process of buying its own shares. In that case, its shares might trade lower for a while, even though the total number of shares outstanding has been reduced by the buyback. Generally speaking, though, a share repurchase program will tend to boost the stock price over time. That's not just because of reduced supply of shares, but because buybacks tend to improve some of the per share metrics that investors use to value a company. A lot will be different from a valuation standpoint after a buyback. When a company buys back shares, the total number of shares outstanding on the market reduces. This will affect a whole bunch of valuation metrics, such as earnings per share or EPS, or cash flow per share, CFPS. These will increase as the shares used to produce the figures in the equations reduce. Because of this, be very aware that your final figure, when working out these per share metrics, could be artificially inflated because the increase can't be attributed to economic value creation activities such as boosting earnings or cutting costs. Again, the company is using excess cash to buy its own shares. Because of this, share buybacks reduce the company's total number of shares outstanding and the total amount of cash on the company's balance sheet. And those changes affect several metrics used by investors to estimate the value of a company. Once shares are repurchased, they're usually cancelled entirely and cease to exist. Your earnings per share or EPS just went up 20%, but earnings didn't go up at all. Reducing the number of shares outstanding affects calculations such as earnings per share, which then also affects a widely used valuation metric, the price to earnings ratio. If total earnings stay constant, but the number of shares outstanding falls after a buyback, the company's earnings per share will rise. Taking that one step further, if the company's stock price stays constant but earnings per share rise, its price to earnings ratio will fall. Buybacks also reduce the amount of cash on a company's balance sheet. That in turn increases return on assets because the company's assets or cash have been reduced. Return on equity will also rise because there's less outstanding equity. None of these may be an issue at all for the company you're analyzing, but the main takeaway is to always be cautious that the figure you're looking at isn't artificially inflated in some way, buyback or other. Based on all this, you should proceed carefully if the buyback appears motivated by management's desire to improve its valuation metrics. A company that uses buybacks to create the appearance of quick growth in earnings per share, for instance, may not be a company worth owning for a number of different reasons. While a company's share repurchases are generally intended to be bullish for the stock price, the bears might claim that companies tend to repurchase shares after a period of success when they have lots of cash. This means that the company is repurchasing its stock at a high valuation. Imagine if you came across a large amount of excess cash as a windfall, but you ended up investing it all in one company at all time highs. This situation can be very similar. A company in that situation could end up buying its shares at a cyclical price peak, getting fewer shares for its money, and leaving it with less cash in reserve when business slows.